David Bloom, look, I know you want to talk about the dollar, but before we talk about the dollar, do you worry about a flattening yield curve?
No. What I care about, listen, I'm in FX, we do spot. I don't really care about duration. You're telling me about a 10-year bond in 10 years' time with 20 coupon payments. Okay. What I care about is 1 year money in the United States is above 2.25%. So that's beautiful for the dollar, beautiful. Whereas in some countries you look at their dollar-denominated debt and they're offering you like 50, 60, 70 basis points over the US. We've got 125 million of the richest people that have ever lived behind me, backing me up, and the rest of them, what have they got? So you'll have to ask Mr. Lubin here about EM and EM rates, whether they're high enough, especially as US short rates are pushing up aggressively.
Okay, he's also taken over for the questions, which I like that. We have a couple of questions also from viewers for David Bloom. Keep them coming. Just very difficult ones, because he's a little bit rogue this morning. David Lubin, overall, okay, if there's the sign that the yield curve is inverting, does that mean an impending economic slowdown, or is this time different?
For emerging economies, paradoxically, sometimes it's the case that emerging markets' asset prices do best, when the US is in recession. In other words, because that's when US yields, short-term interest rates go down, the dollar weakens, and that tends to push capital towards emerging markets. What we're seeing at the moment is that because the dollar is strengthening, that is sucking capital from EM. And the paradox is that one's instinct is to think that it's actually US interest rates that matter in terms of pushing capital towards emerging markets or pulling it away. But we've seen an 80-90 basis point rise in yields since September last year. And it's only been since the dollar started strengthening a couple of weeks ago that EM FX has started to weaken. We had this long period between September and April where US interest rates were going up, but capital was still flowing to emerging markets. But so where we are at the moment is that we know that some measure of US monetary conditions matters for capital flows to emerging markets. Yeah. At the moment, it just happens to be the dollar that is the actual measure of US monetary conditions that matters.
How unfortunate for David Bloom, who doesn't want to talk about interest rates this morning too, sir. But your dollar bullish call does in part rely on interest rate differentials here. So talk us through why you want to discuss your bullish view on the US dollar right now, and why now interest rate differentials suddenly matter when for so long they haven't.
Yeah, I often think it's a bit like an argument. Things build up and build up and build up, and by the time you have this blaring argument, you can't even remember why it started. So things have built up. I mean, volatility went up in the equity markets quite substantially. You know, you've had lots of, you've had the slowdown in Europe. You've had other central banks pulling away from raising rates. And on top of that, the Fed is still going for it. And you had 70, 80 basis point rise in the short end. And it was all building and building. And suddenly it happens. And that's just how life happens. I wish there was some kind of smoking gun I could point to, but it's a combination of events that led to the dollar surging ahead, and especially, I think, the shorter-term money. I'm less worried about the yield curve. I'm more worried about short-term money in the US. When you don't know what to do in the world, it's delicious. You can get like 2.25, 2.5 without much duration. It's beautiful.
How much higher, then, can you see the US dollar going here? And it's not just about a dollar story. There's all sorts of cross-currencies here that are playing into the dollar strength that you're anticipating.
Well, the reason we've got limits on this dollar strength and we don't see it as a full-blown bull market is the experience of 2014. If EM gets into trouble and the dollar goes surging ahead, then the Fed pulls back, the dollar goes back down. So there's some kind of limit, we think, to the dollar strength.
David, does the president want a stronger dollar?
No. It's quite clear that this current administration...
So can they stop it?
No, I mean, the current administration is quite clear, and we had Mnuchin in speaking one of those ski resorts, the Chamonix or Davos, I can never remember, saying that a weak dollar is in the US interest as far as it relates to trade. There was a very big change from the Robert Rubin line, and that led a lot of people to think the dollar was in a bear market.